Hello guys, welcome to iTutor Academy. In today's session, we will start with Unit 14, subsection 6 of MMBC 004, that is DuPont analysis. The most important aspect of FAME's operation is the rate of return the FAME is able to generate on the equity investment made by the shareholders. Equity shareholders are the real owners of the FAME and take all the risk. Hence, a return on equity ROE needs to be analyzed in greater depth. This is achieved by the DuPont analysis, which breaks down the ROE ratio into its three important components. These three components of performance measurement are profit margin, asset turnover, and equity multiplier. Return on equity ROE is equal to profit after taxes, that is PAT divided by equity. This is the equation of this return on equity. And again, here is an equation. You just try to do this. An example also here. Net profit margin indicate the profitability. Asset turnover ratio evaluate the efficiency in the usage of the asset of the firm, while equity multiplier is a proxy for financial leverage. Thus, the DuPont analysis highlight that a firm may increase its ROE by maintaining a high net profit margin, efficient use of total asset, and optimum leverage. If the ROE falls, the firm must investigate these three financial performance in measure to identify the reason for such fall and take corrective steps. And using financial ratio to predict bankruptcy. Edward Altman, that is, investigate cases of business failure in the US. In his study, he included a sample of 66 industries companies, of which 33 were bankrupt fame and 33 non-bankrupt fame for 20 years from 1946 to 1965. Based on the data provided by the annual report of the companies, Altman examined a total of 22 potential financial ratios, out of which he retained 5 ratios that had the highest significance based on statistical techniques that were most important ratio in predicting business failure. Altman used the multiple discriminant analysis technique, which categorized firms into those that are likely to fail and those that are not likely to fail. Based on his study, Altman developed the following formula, which combines these 5 ratio and assigning weights to each of these ratio to arrive at one composite score, which he called the Z score. So Z score is here. So here is x1, x2. X1 is net working capital to total assets. X2 is retained earning to total asset. X3 is earning before interest and taxes to total asset. And X4 is market value of equity to total liability. X5 represent the sales to total asset. So here is an explanation for x1, x2, x3, x4 and x5. So you just go through your IGNOU study material for that and you just read it, and in case any doubts in between, you can contact us. And here is an one example also here related to the same, and you just try to do that. And the next one is application of financial ratios. Ratio analysis is an important technique of analyzing the financial performance of firm. Different stakeholders use financial ratio to evaluate the firm's performance from their own perspective. The following are therefore the application of financial ratios. And assessing, the first one is assessing the performance of firm. As stated above, different stakeholders want to evaluate the financial performance of firm from their perspective. Shareholders want to evaluate if the business enterprises is profitable and financially strong or not. And next one is credit analysis. Ratio are used to judge the credit worthiness of potential customers. Ratio like current ratio, asset test ratio, debt equity ratio, interest coverage ratio are evaluated to decide whether credit should be extended or not, or further loans should be sanctioned or not. And forecasting bankruptcy, as discussed above, Altman's Z score is an important technique to predict the chances of business failure. And valuing firms, valuation of firms is an important aspect of the usage of financial ratio, as the valuation of firm is dependent on the profitability and efficiency of a firm. The valuation ratios such as PE, EV, EBITDA ratio, MB to a BV ratio are used extensively by analysts and issue in using financial ratios. Although ratio analysis is an important tool in the analysis and evaluation of the performance of a firm, there are certain issues while using them, and some of the issues in using the financial ratio are as follows. And the financial ratio are calculated based on the financial statements, the balance sheet, income statement and cash flow statement, and no two companies are exactly similar in their asset profit, that is capital structure, technology being used, market, products, etc. Further, companies also change over a period of time. Hence, as the profit of companies changes, it becomes difficult to compare the ratios. The comparison of ratio which other firm or over time period might become problematic. And although the financial ratio have been defined as discussed in the previous chapter, there exists a wide variation in the definition of a certain term, which makes the comparison of ratio difficult. And besides comparing the ratio over time, they are sometimes compared with the industry average also, such as database is maintained by the Reserve Bank of India. PROVES database maintained by the Center for Monitoring Indian Economy is another such a database of Indian firms. Summary is here for this chapter. In order to understand the financial statement of a firm and make conclusive comment on the financial performance, we need to compare the ratios over time and compare them with the other similar companies. Techniques such as comparative statement analysis, common size analysis, trend analysis and interfirm analysis are popularly used. DuPont analysis decomposes the performance measure of return on equity into its three important components that need to be investigated in depth for reason for poor performance. Altman's Z-score is used to predict the possibility of a firm going bankrupt in the near future, and properly combined financial ratio are used to assess corporate excellence, judge creditworthiness, predict bankruptcy value shares, and although financial ratio are a useful tool, there are certain issues encountered. Hence, ratios should not be used blindly but they with due caution. And keywords are there from this unit, and test your understanding. That means long answer question. First one is discuss the difference between comparative statement analysis and common size analysis. We already discussed. And explain in detail the DuPont analysis. Describe the Altman's Z-score model for predicting the bankruptcy of a firm, and discuss the used and the application of ratio analysis. Discuss the problem and issue faced in analyzing the financial statement. These are the questions from this unit. Try to answer this. It will help you for your term and examination. And for in between any doubt, you can contact us. And for more IGNOU MBA videos, you just do share, like and subscribe our channel and support us. Thank you so much.
i-tutor ES presents IGNOU MBA complete syllabus coverage classes and individual semester base subject coverage program for MBA students, online and flexible sessions. For more details, contact 62382 17885.